Good morning. Welcome to an episode of the Mizuho Week Ahead. I am Boon Heng, market economist at Mizuho Bank. This week's theme is downward whipsaw. Even as the week was filled with exemptions, U-turns, and amendments, the deteriorating risk sentiments in the US was clear. With the S&P 500 down 3.1% for last week, the dollar sinking, the DXY plunging 3%, despite elevated USD yields. The latter was assisted by Fed Chair Powell, who said that the US economy is in a good place, despite a mild underperformance from the NFP print last Friday. To recap, last week, the US proceeded with the imposition of 25% tariffs on Canada, Mexico, and raising additional tariffs on imports from China to 20% from 10% earlier. This was subsequently tweaked to allow exemptions for goods under the USMCA agreement in the form of a 1-month delay. Tariffs on steel and aluminium is still being expected to go ahead on the 12th of March this week. Even amid these exemptions, it is worth keeping in mind that tariffs remain in place on broad-based imports from China, as well as a smaller proportion of imports from Canada and Mexico. The initial retaliation from Canada remains in place, even as further escalation is pushed back to April 2nd to align with Trump's reciprocal tariff plans. For now, Mexico has offered to examine potential for tariffs on imports from China. Meanwhile, the ECB cut rates by 25 basis points last week, but characterized the stance as meaningfully less restrictive and was duly cautious on defense spending. After all, aside from legislative hurdles, longer-term defense strategy and capacity build-up will mean that the economic boost may not materialize in the near term. Nonetheless, the euro has been boosted by the defense-led inflows. At China's MPC last week, they announced growth target of around 5%, which is similar to that in 2024, though the bar remains a high one for this year, considering external tariff risks and domestic woes of deflation amid a still stagnant property sector despite initial signs of stability. On the policy front, focus continues to be on supporting domestic consumption with plans to study the possibility of a higher consumer loan quota alongside efforts to lean against demographic headwinds. Meanwhile, the inflation target in China was expectedly lower to around 2% for 2025. Central bankers worrying about inflation was provided marginal relief last week. The OPEC Plus announced their decision to increase oil production by 138k barrels in April to send Brent crude prices tumbling to below $70 per barrel last week. While headlines attempt to signal implicit adherence to Trump, the calculus of increasing supply to maintain their market share, as well as suppressing margins of US shale oil producers, should not be entirely dismissed. In EM Asia, there were no surprises at Bank Negara Malaysia's meeting last week when policymakers held rates steady as widely expected, with the BNM expecting sustained robustness in economic activity for 2025, ability to weigh risks and inflation to be managed. We expect a prolonged hold by the BNM. The ringgit's directionality, however, will be susceptible to spillovers from external trade headwinds. Meanwhile, Vietnam's data continued to reveal economic soft spots, but calls for policy easing may rightfully not be heeded by the SBV as Vietnamese Dong Woos take precedence amid still limited FX buffers. For the week, the Taiwanese dollar was a clear underperformer as Woos ranged from the implications of a CHIPS Act removal to existential defense worries. Looking ahead, Fed speak will be absent as the Fed enters blackout period, but the US CPI print on Wednesday will continue to invite chatter about policy path. In the data light week for EM Asia, we expect Korea's unemployment rate to decline very mildly, but sectoral perspective should display softness in the pace of hiring gains. Meanwhile, China's CPI returned to deflationary territory over the weekend, and EM Asia FX may be left to ponder if they can hold on to their gains or even stretch their rallies further, considering that the current levels are still underperforming to the broad DXY drop to 104. For more information on the events this week, please refer to our week ahead publication or contact your respective sales desk and RMs. And for regular notifications on our market views, please subscribe to our channel and hit the notification button. Thank you.